There's a company rapidly buying up every piece of real estate it can get its hands on. Its buildings house some of the best stores in the US, Bass Pro Shops, Burger Kings, and even the illustrious AMC theaters. Today, I want to examine Store Capital, a no-name company building a real estate empire. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. Store Capital is actually one of the youngest companies I've talked about on this channel. Founded in 2014 by Christopher Volk and Mary Fedwa, the initial idea behind Store Capital stretches a lot further back in time. In 1986, 27-year-old Christopher Volk started a job at Franchise Finance of America, where he learned about and worked to further the revolutionary concept of sale-leasebacks. The idea behind sale-leasebacks, in short, is often companies aim to have lower total debt on their books. The best way to do this is usually through this process of leasing a physical building. For example, AMC would rather use the total value of the building itself to reinvest in its business, not drop the money on owning a physical building. In comes Store Capital. Store buys up the building, then AMC leases the building from Store. At the end of the day, both parties benefit massively from this process. AMC gets the cash value from the property and isn't tied down by a large amount of debt held in physical buildings, and Store gets a long-term lease and cash flow. Christopher Volk experimented with this idea when he started two other companies using this business model. Both would eventually be sold. A little while later, in 2011, with a few like-minded people, he would found his third company, Store Capital. In the 3 years between its founding and going public in 2014, the company grew its assets from less than a meager $100 million to nearly $2.8 billion. Even Warren Buffett gave his nod of approval when he invested nearly $400 million, effectively owning nearly 10% of the company. While there isn't much more history to cover from here, I'll go over a widely unfamiliar aspect of the business, the Real Estate Investment Trust, or REIT. Technically, Store Capital is classified as a REIT. This structure is a special entity developed by the US in 1960 that allows regular investors to own a piece of the large real estate company pie. However, there are strict regulations these companies have to adhere to in order to claim REIT status. The biggest and most obvious regulation is that the company has to invest in real estate. Obviously, most of the revenue of the company has to come from that real estate, also pretty obvious, but most importantly, REITs must pay out at least 90% or more of this income in the form of dividends to shareholders every year. This allows a REIT to skip taxes and still have 10% of its income left over to grow the business. That's why anytime you find a REIT, you'll find a big, often 3% plus dividend. With this structure, the regular investor can invest in real estate in a cheap and effective manner, while avoiding most of the work that comes with physically owning properties. So what does a typical REIT's financials look like? Well, for Store Capital, that's passing $10 billion in assets as of June 2021, with a steady increase in acquisitions. Its portfolio now boasts over $11 billion in assets as of its most recent quarter. In terms of revenue growth, Store has been fairly consistent, except in 2020. That year turned out to be a particularly difficult year for many real estate companies. Virtually all of them saw rents fall as tenants found themselves unable to operate due to lockdowns. However, Store eventually managed to rebound and even ended up with revenue growth by the end of 2020. By 2021, the company was back up to full capacity and collecting almost all rents. As for shares outstanding, REITs are somewhat interesting. Given the fact that all REITs have to pay out 90% of their profits to shareholders, the only viable way for the companies to continue growth is by issuing more shares, selling them, and using the cash to acquire more real estate. That's why you see the drastic increase in shares over the last 5 years. In terms of free cash flow, it's also steadily rising, keeping in line with the revenue. Although in 2020 we actually saw a tick down in overall free cash flow, higher costs and lower rent collections are most likely the reason. Unfortunately, REITs also tend to earn lower returns on their invested capital as their ability to grow quickly is severely hindered. Store's ROIC last year was 6.7%. Over the last 5 years, it's been 4.9%, and this is actually slightly above average when it comes to REITs as well, so it's not too bad. One area in which REITs are usually pretty strong is the actual balance sheet. On the surface, it may not look great for STORE. It has $808 million in current assets, with only $30 million of that in cash, against $4.8 billion in liabilities. However, digging a little deeper, we see most of this long-term debt is CLO debt. CLO debt, or capital lease obligations, is a form of long-term debt on buildings, and this is the best kind of debt to have. It's basically infinitely negotiable, with some loans extending multiple decades. If for some reason STORE needs to pay back the debt immediately, there's always the option to sell the building to pay the debt. Taking all this into account, STORE really only has its debts that it owes by the end of the year, equaling $612 million. This is very easily covered by the current assets it has coming in. Finally, we come to the holy grail of REITs, the dividend. With a yield of 5.9%, the usual payout of 90%, and a 5-year growth rate of nearly 6%, STORE Capital is a fairly high yield option for those looking for some extra income every year. While STORE Capital is certainly one of the better off REITs, is there actually anything significant that sets it apart from the other 200 plus REITs on the market? The answer to this question is a definite yes. Why? Because it's buying every store in the US. Have you ever heard of a triple net lease? The triple N is a relatively new capital structure. It sees a company owning a building with the leasee of the building paying everything from property taxes to maintenance fees. This is STORE's bread and butter. It gives the company tremendous flexibility. Because the lessees are responsible for everything inside the buildings and every other expense related to operations, STORE only needs to make sure that companies occupy its buildings and then go collect lease payments every month. Now, if you're new to investing or aren't as familiar with this real estate structure, know that a lot of other companies do this. As I mentioned earlier, over 200. The real estate these companies own range from Amazon warehouses to shelf space to storage units. In STORE's case, single-tenant operational real estate. This focus is another big way STORE stands out from the crowd. With other real estate companies, usually a large portion of total revenue comes from its top 5 tenants. Companies like MPW rely on one hospital chain, Stag Industrial relies almost entirely on Amazon for its revenue, and even Realty Income Corp, STORE's largest competitor, gets nearly 20% of its revenue from its top 5 tenants. Contrast this to STORE and the fact that its top 5 tenants only account for just under 12% of its total revenue. That's a pretty big difference. To dig even deeper, STORE also has another massive advantage when it comes to the length of these leases. STORE's average lease length is 17 years or more. This compares well against Realty Income, whose average is 12.5. You can attribute it to the smaller size of the deals STORE makes. It allows STORE to avoid some of the big box retailers who want more flexibility in lease terms. The smaller deal sizes also allow the REIT to have a much higher cap rate over its competitors. If you aren't familiar with cap rate, it's the return on capital an asset generates based on the price paid. STORE usually has fairly high operating income from its leases and lower prices paid for the buildings themselves. One of STORE Capital's biggest criticisms, though, is that many of its tenants tend to be smaller businesses and have a higher risk of defaulting on payments. To address these concerns, let's look a little deeper at STORE's tenants. Another fun point is STORE's top 10 customers account for less than Realty Income's top 5 too. On the list are several well-known but smaller national chains like Bass Pro Shops, Ashley Furniture, and of course, the illustrious AMC Theaters. Across the top industries, STORE is heavily focused in restaurants. While this matters less than individual tenants, it's important to know about as the area can be easily affected by broader market trends. However, most of STORE's customers are actually larger, small businesses with in excess of $200 million in annual revenue and employees totaling more than 2 million. This shotgun-esque approach of working with lots of small businesses often leads to new customers coming from these pre-existing chains that want to expand. Remember when I said this company is buying every store in the US? Well, I'm not lying, and I'm not even really exaggerating. STORE's acquisition pipeline stands at over $13 billion. These are future deals that STORE is negotiating. They're expected to be executed in the coming years as new capital comes in. This all leads to a real estate company company that's really only getting started, offering near bond-like stability through its triple net leases and a growth rate far in excess to its larger and older competitors. I believe STORE is well positioned to capitalize on a growing small business market in the US. But there's one more reason I think STORE will be a stellar company, especially over the next few years. There's this little thing that you may have heard of called inflation, a scary word for many people since it incurs rising prices on the most necessary products we need to live. While this is definitely an issue for the vast majority of the US population, it's a boon for big real estate companies. Because for businesses like STORE, these rising prices caused by inflation allow them to sell buildings at increasingly higher prices. These profits go back into the business. STORE also has tremendous pricing power to raise rents on its tenants, even to their detriment. Especially in the event of rising inflation, even in troubling times, you can get a good investment in real estate, especially in STORE since it particularly stands to massively benefit from higher inflation numbers. Speaking of inflation, consider helping this channel grow with a sub and a like below. STORE Capital sounds just about perfect to fill the holes left by the other REITs in the market, but like any other business, there are aspects of the company that leave a lot to be desired. One of the bigger events that caused a buzz amongst investors was the sudden departure of founder and CEO Christopher Volk. In December 2021, the company filed an 8K announcing the sudden termination of the CEO, quote-unquote, without reason. This came only months after he announced he would pass the reins of CEO over to co-founder Mary Fedwa. Volk was supposed to remain as STORE's executive chairman, however, it seems that's changed. He was released just a few months ago. There aren't any explicit reasons why either, and the shakeup is somewhat concerning. In this case, I'd say that concern is amplified by the fact that Volk was an instrumental figure in the company's creation and growth. As far as I know, based on the evidence, he was a capable leader. Still, it's concerning when a major leader of a company suddenly steps down or is terminated without reason. This problem has a direct correlation with my other problem with STORE, and that is most of the buildings it acquires are run by fairly small companies. Often, these businesses don't even have credit ratings, so the risk of taking on deals with non-rated businesses is completely unknown. With Volk at the helm, I had the confidence as an investor that there was a competent leader with many years of experience behind him. With his departure, it's uncertain whether or not current management can continue making these same types of deals at this same level. It could signal a shift in the company away from those smaller deals and perhaps onto bigger ones. Of course, this is especially true if STORE continues to scale the business at its current rate. Change will of course be needed. It's hard to say whether that possible change will pay off or not. Another area that STORE needs to move away from is its heavy focus in the service industry. It makes up more than 60% of the company's total assets, a hefty concentration for sure. STORE needs to diversify its portfolio to be better balanced and more risk averse. The company can certainly do it, but it will definitely take time. As investors, we just can't be sure how long. One more thing many investors may not think about is another aspect that sets STORE apart from other REITs. STORE is 100% in the US. There's no outside exposure to other international markets. While there are some investors who may celebrate this, I'm not exactly one of them. If the US market entered a recession, STORE has no backup from global markets. It would bear the brunt of that specific headwind. Many other REITs don't have this specific risk attached because they're diversified globally. Aforementioned MPW diversified all over the world, expanding to Europe and Australia. Realty Income Corp has significant holdings in other markets as well. I believe STORE will eventually start investing beyond the US borders, but until then, it's another mark against the company from me. On one side, there are a lot of risks involved with investing in a REIT like STORE because of its lack of diversity both internationally and from a business aspect. At the same time, it's a REIT unlike others in the market because it's filled the gaps left by its largest competitors. A good portion of revenue doesn't come from just 4 or 5 of its largest tenants, but a whole array of smaller businesses. Then again, the man who led that effort is suddenly gone, leaving an uncertain future. There's good and they're certainly bad. With that in mind, will I be investing in Store Capital? The answer is yes. Actually, I'm already an investor. In fact, it's my 6th largest holding. You can see for yourself by checking out Common Stock, where my personal portfolio is always public. Link in the description. Now to valuation. I think the company is worth between $45 and $50 per share. Given the risks involved uniquely with Store, I would add about a 20% margin of safety to that. With that, I get a fair value between $35 and $40. In other words, I think the stock is fairly undervalued and a pretty good deal. That's why I even increased my position by over 50%, making it one of the largest positions in my entire portfolio. Well, that's all I got for this video. If you enjoyed, I'll bet you also enjoyed the video popping up on screen now, but with that said, I'll leave you here. Until next time, I'll see all of you in the next episode of Dollars and Cents.